$6 trillion disappeared in less than 60 minutes, and the explanation you're being given is not the real one. Gold and silver didn't collapse because investors suddenly lost faith. They were pushed hard by a force most people never look at until it's too late. While everyone was watching metal prices flash red, something else moved first, and that move made this crash inevitable. This same setup has appeared before, and every time it does, it catches unprepared investors off guard. The most unsettling part? The signal that caused this drop is still active right now. If you don't know what it is, you're already behind. More than $6 trillion disappeared in less than an hour, and most people still don't understand what actually happened. Screens went red, metals collapsed, stop losses detonated, and portfolios bled in real time. Gold and silver didn't just dip, they were violently repriced. While mainstream headlines shrugged it off as volatility, something far more important was unfolding beneath the surface. This wasn't chaos. It wasn't random. It was a mechanical reset driven by forces most investors never watch. If you don't understand what triggered this move, you won't just be surprised again, you'll be positioned on the wrong side of the next one. What happened today matters, and what happens next matters even more. When markets collapse this fast, the instinct is to assume something broke. But gold and silver didn't fall because they suddenly lost value. They fell because pressure built elsewhere finally released. In moments like this, price doesn't move on belief or emotion, it moves on leverage. Once selling begins, forced liquidations take over, margin calls hit, positions are closed automatically, selling accelerates itself. That's why declines feel violent and unfair. It's not opinion, it's math. The people hurt the most are those who entered late, overextended, or without understanding what actually controls short-term price movement. This was a structural flush, not a failure of the metals themselves. The key force behind this crash wasn't gold, silver, or fear. It was the US dollar. Most retail investors ignore it completely, yet professional traders monitor it obsessively. Gold and silver are priced in dollars, which means the dollar's strength directly affects their price. When the dollar surges, metals almost always fall. When the dollar weakens, metals rise. This inverse relationship is not a theory, it's foundational. Today, the dollar spiked aggressively. That single move tipped the entire balance. While most people stared at metal charts in disbelief, institutions were already positioned because they were watching the real driver. The dollar didn't rise by accident. It moved because policy expectations shifted. The Federal Reserve signaled that interest rates may remain higher for longer, which instantly makes dollar-denominated assets more attractive to global capital. Higher yields pull money into the dollar, strengthening it rapidly. That strength creates immediate pressure on metals. This is why markets move before official announcements feel real to the public. By the time headlines explain what happened, positioning has already shifted. The dollar reacts first. Everything else follows. Today was a textbook example of that sequence playing out at speed. Silver suffered more than gold for a reason. Silver isn't just a monetary metal, it's deeply tied to industrial demand. When economic data weakens, especially from major manufacturing hubs, silver reacts faster and harder. Slowing production, reduced output expectations, and uncertainty around future demand hit silver disproportionately. That's why silver amplifies both rallies and crashes. It outperforms on the way up and underperforms on the way down. This volatility isn't a flaw, it's a characteristic. Anyone trading silver without respecting that amplification is accepting risk they may not realize until it's too late. Another accelerant was uncertainty. Political risk doesn't need to resolve negatively to impact markets. It only needs to exist. When deadlines approach and outcomes are unclear, traders reduce exposure first and ask questions later. After massive gains in a short period, many investors were already sitting on large profits. Today provided the excuse to lock them in. Profit-taking isn't bearish by nature, but when combined with leverage and dollar strength, it can trigger sharp corrections. Fear doesn't need a reason, it just needs permission. What makes this moment especially important is that it isn't unprecedented. The exact same emotional pattern appeared weeks ago. A sudden sell-off, panic, doom narratives everywhere, and then a powerful rally that erased fear and punished those who exited at the bottom. Markets don't move in straight lines, even in strong trends. Corrections are how momentum resets. They shake out weak positioning and transfer assets from emotional holders to patient ones. The price action may look chaotic, but the behavior behind it is remarkably consistent across cycles. The fundamentals that pushed metals higher didn't disappear today. Central banks are still accumulating. Long-term currency confidence continues to erode. Supply constraints remain real. Industrial demand hasn't vanished, it fluctuates. What changed today wasn't reality, it was sentiment. Sentiment can collapse in minutes and reverse just as fast. This is why experienced investors separate short-term price from long-term value. One reacts emotionally, the other observes structure. Markets exploit that difference relentlessly. Leverage is what turns volatility into devastation. Unleveraged investors feel pain. Leveraged investors get erased. Stops don't protect in fast markets, they often accelerate losses. When prices gap, exits vanish. Accounts blow up before reactions are possible. This is why sharp moves always end with the same outcome. Capital flows from the impatient to the prepared. Volatility doesn't punish ignorance, it punishes exposure without understanding. The lesson isn't to avoid risk entirely, but to understand how quickly risk compounds when leverage meets momentum. Corrections inside strong trends are where opportunity forms, but only for those who can remain rational under pressure. That doesn't mean blindly buying every dip. It means recognizing context. Is the move structural or emotional? Is liquidity failing or repositioning occurring? Is the driver long-term or temporary? These questions matter more than price alone. The market doesn't reward bravery, it rewards clarity. Those who understand why moves happen don't panic when they occur. The next phase will be defined by how quickly fear fades and whether underlying drivers reassert themselves. Watch the dollar, watch policy language, watch sentiment shifts. Markets often reverse when confidence is lowest, not when clarity is highest. This is where preparation separates outcomes. Those without a plan react. Those with a framework respond. Price always moves first. Explanation comes later. The opportunity isn't in predicting every tick. It's in understanding structure well enough to survive volatility without surrendering position or conviction. What happened today wasn't the end of a story. It was a test of preparation, discipline, and understanding. Markets will always move money from those who react emotionally to those who remain patient and informed. You can't control volatility, but you can control how you respond to it. Use moments like this to strengthen your framework, not abandon it. Learn what actually drives price instead of chasing headlines. If this breakdown helped you see what others missed, stay connected. The next move will reward those who paid attention today and punish those who didn't.